Ever opened a company's annual report and felt lost in a sea of numbers? You're not alone. Today, I'll show you the only 12 financial ratios you need to cut through the noise and instantly understand any business. Grab a notepad. Let's turn you into a financial detective. First up, the current ratio. Current assets divided by current liabilities. This tells you if a company can pay its short-term bills. A ratio above 1 means they're in good shape. Below 1 is a red flag. Think of it as checking if you have enough in your bank to cover next month's expenses. Always start here for a quick health check. Next, the quick ratio or acid test. It's like the current ratio, but subtracts inventory from assets. Why? Because inventory isn't always easy to sell fast. This ratio asks, if sales stop today, could they still pay their bills? Above 1 is safe. Below 1 means they're relying too much on inventory. It's a tougher test for financial stability. Now, gross profit margin. Gross profit divided by revenue. It shows how much profit is made from each sale before overhead. High margin? They're efficient or have pricing power. Watch for declining margins. It could mean rising costs or price wars. Net profit margin is the real bottom line. Net profit divided by revenue. It reveals how much of every rupee in sales becomes actual profit after all expenses. High and stable net margins signal a well-run business. Low margins mean costs are eating up profits. Return on equity, or ROE, is net income divided by shareholders' equity. It measures how well management turns your investment into profit. Consistently high ROE? That's a sign of strong leadership and a competitive edge. But beware, too much debt can artificially boost ROE. Inventory turnover, cost of goods sold divided by average inventory, shows how quickly products sell. High turnover means efficient sales and less risk of unsold stock. Low turnover, products might be gathering dust, tying up cash. Always compare to industry averages for context. Debtors turnover ratio. Net credit sales divided by average accounts receivable. It measures how fast a company collects money owed by customers. High ratio. Cash comes in quickly. Low ratio. They're waiting too long to get paid. Watch for declining trends. It could signal trouble collecting payments. Asset turnover ratio. Revenue divided by total assets. It shows how efficiently a company uses its assets to generate sales. Higher is better, but compare within the same industry. Low ratio? They might have too much invested in underperforming assets. Debt to equity ratio. Total debt divided by shareholders' equity. It reveals how much the company relies on borrowed money. High ratio means more risk, but also potential for higher returns. Too much debt can be dangerous, especially in tough times. Compared to industry norms, what's risky for one sector may be normal for another. Interest coverage ratio. Earning before interest and tax, divided by interest expense. It shows how easily a company can pay interest on its debt. Above 2 is generally safe. Below 1 is a big warning sign. If profits drop, can they still pay the bank? This ratio tells you. Earnings per share, or EPS, net profit divided by number of shares. It tells you how much profit belongs to each share you own. Growing EPS is a great sign, but check if it's due to real profit growth, not just share buybacks. Always look at the trend over several years. Price to earnings ratio, or PE, market price per share divided by earning per share. It shows how much investors are willing to pay for each rupee of earnings. High PE? Investors expect big growth. Low PE? Maybe it's undervalued or in trouble. Compare PE within the same industry for real insight. That's it. 12 ratios that give you X-ray vision into any business. Master these, and you'll spot strong companies and avoid risky ones with ease. If you found this helpful, like, share, and subscribe for more simple finance tips. Thanks for watching Facts. Let's make finance simple together.